We are going to start the next session. And this is going to be very interesting as well. It's going to be very forward-looking. What is the future of fintech? And so the moderator is Dan Gorfine, who actually, he was previously the first Chief Innovation Officer at the CFTC and also Director of the lab, CFTC. He has also founded the Digital Dollar Project, right? And so Dan is going to introduce the rest of the panel.
Thank you so much. You guys can hear me okay? Maybe I need to, maybe on means something. Yes, okay. So hello, I'm Daniel Gorfine, and I have the task of moderating the last panel of the day on what's been an exciting day. Our panel is titled The Future of Fintech. What Jalapa didn't tell me is there was a colon, and after the colon said DeFi, NFT, smart contracts, Metaverse, and Web3. So, and more, because that's not enough for our final conversation. So look, earlier today you heard a lot about specific digital assets and financial instruments. So you talked about cryptocurrencies, stablecoins, CBDCs. In this conversation, we will touch on those actual instruments and assets, but we're also going to talk about the underlying and broader infrastructure, some of the technologies that are associated, and the broader systems that could underpin a future world of digital assets. We're also going to talk about policy and regulatory approaches that are inevitably impacting and intertwining with these developments. So with that, we have a bit of a metaverse going on here today, because half my panelists are in the room, half are virtual. At least they're not like emojis or anything. But let me actually start with our virtual participants. So maybe Jill, I'll start with you, and I'll ask all of our speakers to briefly introduce themselves. And then if you're willing to, position yourself as a bull or a bear when it comes to all of those items that I listed after the future of fintech. So with that, Jill, let me ask you to introduce yourself.
Yeah, thanks so much. It's great to be here, albeit virtually. You can all hear me okay?
We hear you great.
Great. So yeah, my name is Jill Gunter. I'm a co-founder of a company called Espresso Systems, and we're working on bringing both privacy and scalability to Web3 systems, and hopefully through that, making them ready for more mainstream adoption, more institutional adoption, and so forth. I would definitely position myself in the bull category. I've staked my whole career, my whole livelihood at this point in this industry. I've had the pleasure of working in crypto and on blockchains for the last 7 or 8 years now, full time in various roles and for a manner of different projects. And I would say that the lessons learned from that have made me both very bullish on the potential of what can be delivered, but also very much a realist on just how far we have to go. So maybe I'll start with that kind of broad position statement, and we can get into more detail over the course of the conversation.
Fair enough. Thank you. All right, let me turn to Jonathan. Jonathan, can I ask a brief intro, and bull or a bear?
Good to see you, Daniel, and hello to everybody in Philadelphia. I'm calling in from Stockholm this evening. But my name is Jonathan Padilla. Formerly ran a blockchain strategy at PayPal. I have a research lab over at Stanford. But I'm joining you today in my capacity as CEO of Snickerdoodle Labs. Snickerdoodle is founded on the premise that people should own and control their data, and the infrastructure we're building is very much focused on moving the aggregation point of data from big corporations to the individual. And so in light of that, I'm very bullish on this technology. I think we're really at the cusp of mainstream adoption and the cusp of really this becoming more than just the playground of a small group of elites and really becoming something that is widespread across large segments of the population. So as people are building across the board, I think the UX, UI, and a number of the technical features that have impeded rapid development of blockchain and these types of things will give way. And with that, how can you not be a bull, even in light of recent market turmoil?
Arguments. Now, do we have Christian on yet? I know we're waiting for one more to join virtually. And Christian, are you on? No. Not yet. Okay, so hopefully he'll join us shortly. But with that, let's come back to the real world. I've got Matt Homer sitting next to me. Matt, if you would, same question.
Yeah,
Introduction
thanks,
and
thanks,
bullet
Daniel, and good to be here with everybody. Matt Homer, regulatory background. I've been a regulator twice. Earlier in my career at the FDIC, and then more recently at the New York State Department of Financial Services, where I held the job that Caitlin Azro, who we heard from earlier, now has, and oversaw the licensing and supervision of a lot of large crypto companies in the U.S. And it's an interesting question because I think, I actually think, and this may be surprising, that it was my time as a regulator that made me more of a bull around this space. In part because I think from a supervision perspective, I think you can regulate and supervise the space in an entirely new way that is potentially much more effective than traditional supervision and regulation. But I also think a few other things, just very practical reasons why this space will continue to grow. Billions of dollars earmarked for the space that has to be invested. Talent continues to go to this space. And the underlying rationale for why a lot of innovators go into this space has not gone away. That people want, and there are multiple rationales, but I think that kind of potentially a loss of trust in financial institutions being one of them.
Okay, and then Tim, if you'll round us out.
Yeah, good afternoon, everybody. Pleasure to be here, and thanks, Julipa, for the invite. Tim Vanderham, formerly CTO for NCR, so free agent today, as I sit here. NCR, 137-year-old company, and I had the privilege of being the chief technology officer, serving financial institutions, restaurants, and retailers, running payment networks, financial service software, retail software, etc. And very much a bull on this because of the consumer demand and where consumers are going. And while we might look around this room and we might hear comments that there's not as much demand today as we know there will be in the future, there is a lot of demand in generations that we may not all talk to every day. And so when I talk to financial institutions over the past 4 years, retailers, restaurants, and ultimately the only way that those industries get loyalty, which means get more revenue and grow their businesses, is by consumer engagement and consumer loyalty. And that's why I'm very bullish on this, because that immediacy, that speed, that optionality we heard about this morning, that's where the next generation of users is going. That's what they expect. You'll hear more about that from me this afternoon. And that's why I'm very bullish on this, even coming from a 137-year-old company in my last role.
All right, so we have a lot of bulls, so we'll have to pressure test this a bit. But let me start with this first question. So we have a lot of really broad concepts to work through, and I want to start by defining them. So in particular, let's talk a little bit about what DeFi means, what's the metaverse, and what's Web3. Are these real things, or is this excellent marketing? Should I just read Ready Player One, which I did recently, and I was like, oh, so maybe that's the metaverse, or maybe the Matrix. But with that, maybe I'll start with you, Jonathan. Can you give us some definitions? Start with DeFi, and then tell us about Web3 and metaverse. Is that one and the same? What are we talking about?
Yeah, it's a good question. I mean, definitions, oddly, are sometimes the hardest things to do, especially if you're a legislator or regulator. Those tend to take more time than actual policy. I mean, I would define DeFi very straightforward as basically a way to do finance leveraging smart contracts and disintermediating a central authority. I mean, that's kind of definitionally what DeFi is. It's decentralized. But the important thing is that this allows us to kind of have everything from lending and a number of other diverse applications without a central mediary. That's the core of what DeFi is. If we think about the differentiations between, say, Metaverse and Web3, those are actually, I think, very different things. Metaverse seems to be more of jargon around a combination of augmented reality, virtual reality, and these things coalescing within a spectrum. While Web3 is really kind of broadly more encompassing of where blockchain technology is leading and the type of social constructs around that. So you can have things that are Web3 but are not Metaverse. But I think given where Metaverse is, it kind of is a requisite to have elements of Web3 in there.
Tim, I might ask you anything to add to that, and then I'll open it up to our other panelists if anyone has any additional points on definitions.
I think Jonathan did a great job of describing them. I'll just give an example I think that's really real for this, which goes back to why I think it's a bull and why I think we all need to embrace these concepts of DeFi, Web3, and Metaverse. So how many people in this room would stand for and be loyal to a brand that didn't bridge the physical to digital world, right? We've heard digital first from our banks, from every industry for the last 5, 10, maybe even 15 years in some regards, but definitely the last 5 years. And we all expect that on this mobile device that I have in my pocket, or the series of devices that we have that digital experience that replicates our physical experience, and we can transfer between the two. The next wave, and I'll put myself in this category, but then the next wave, our next generation, expect that virtual. So now it's physical to digital to virtual. And that's where you start getting into Web 3. It's not just read, which was Web 1. It's not just read and write, Web 2. It's read, write, execute in whatever medium I'm in the physical medium, in the digital media, or in the virtual media. And I think that's why we all need to, from regulators to industry experts to the corporations, embrace this, because that's what us as consumers are going towards: physical to virtual, or digital, physical to digital, and then on to virtual.
Anything further on that?
I just add, we were talking about this out there before the panel, but if you look at some of the survey data of the Gen Z population, it's the first population ever to really not distinguish between in real life activity and virtual activity. And meeting a friend or for the first time, or discovering a friend in a virtual setting is just as sort of meaningful and powerful as an in real life setting. And so I think that's, for me, not being from that generation, I think it's really important to kind of think about kind of the emerging generation and how their preferences are changing. I think that hybrid world is absolutely an expectation.
All right. Well, we're going to come back to these concepts, Web3 and then the metaverse, but let me focus back in on DeFi. We frequently hear that DeFi is the future of finance and that it might replace traditional banking, traditional markets, traditional intermediaries. Is that right? Do we really think that DeFi can be an alternative to the existing financial system? And with that very easy question, maybe I'll first go to Christian, ask him to introduce himself, and then answer that very simple question I just asked you.
Hi, everyone. I'm glad I was able to connect. Was having some technical issues. Christian Catalini, founder of the MIT Crypto Economics Lab. To your point about DeFi and more generally crypto, at its core, this is a technology that changes the nature of intermediation. It does not necessarily remove all intermediaries from the picture, and I think often that's a misunderstanding. Intermediaries play an important role in society. They ensure that markets are safe. They ensure that certain types of transactions are blocked when necessary. And there's all sort of reasons why over centuries we developed better and better institutions and intermediaries. Now, that said, I think here we have a technology that changes the balance of where do we need intermediaries to have an active role versus not. And so when you look at DeFi, it is rewiring some of the basic infrastructure for finance by shifting the power between participants and the intermediaries that they use every day to complete a transaction, whether it's a payment or a more advanced financial instrument. Will we still see traditional banks and financial institutions in DeFi? For sure. And in fact, I would imagine many of them will reinvent themselves, focusing on kind of the core stack and the core elements of where they can add value, and less on piping and infrastructure. That said, of course, things that were profitable businesses before, I think will be more challenged because a lot of this will be commodified. And so when you have interoperable rails that you can use, when you have interoperable and programmable smart contracts, then a lot of the things that we used to need a lot of, heavy touch activity by an intermediary kind of goes away.
Question. I mean, can this replace traditional finance, traditional markets? And then I guess I'll also ask, do you agree with Christian? Are these just new types of intermediaries that are arising?
I mean, I think when you these types of intermediaries here, you're in a situation where you're going from human to code, and this is where it gets really, really interesting. Lawrence Lessig talked about kind of code as law the last 10 to 15 years. But we're in a spot now where we're relying simply on code, and think about it in this situation between what happened with Celsius over the course of the past few weeks, where Celsius didn't declare bankruptcy until after it had basically paid off a number of the decentralized lending pools that are going to release that collateral. In a lot of ways, that was vindication for DeFi systems over potentially centralized systems, that there's no kind of wiggle room based on an actor who's too big to fail. It really goes down to everybody being treated equally. And there's a lot of power there that, I think goes to show that the system is fundamentally different because it removes some of this kind of human element that is in some ways corrupted systems, and in a lot of ways adds a lot of potential color that makes it political. So I do think it is fundamentally different, and intermediaries are there really just to kind of keep the code clean, to keep it secure. But the smart contracts and those systems are very kind of well defined in those areas.
Jill, hopefully you can hear me as well. I mean, your thoughts on this? Are these new intermediaries that we're grappling with?
Yeah, so I'll be in a way maybe your bear here for a second, and talk to some of the limitations of DeFi as it exists today. Anyway, and just because it's the state of things today doesn't mean that it will be forever, because the rate of innovation in this space is just explosive. But today, DeFi, I don't think, can viably replace existing financial systems for a number of reasons. I think that they offer an alternative financial system in many important ways, and in those ways offer things like better transparency and accountability, these things that Jonathan is speaking to. But today it's important to note that DeFi has very few bridges or direct connections back to what I would call real world assets. I would say that stable coins are an important exception to this, where we have companies like Circle or Paxos or Gemini or even Tether that are creating stable coins that we can trust within some reason. We can kind of reason about the risks here, but we can trust to some degree that they're backed one-to-one by dollars. And so in a way, these stable coins are almost just like depository receipts for dollars sitting in a bank account somewhere. And so that is a pretty direct link, right, from a real world asset, a physical dollar, or a digital representation of a physical dollar, to the sort of crypto or DeFi universe. But we're very hard pressed to come up with more examples of these types of links and bridges. People have been working on, for example, the notion of security tokens for a long time, wherein you might have Apple stock that's represented on a blockchain, but for a host of reasons, many of which are regulatory, that has not come to be. And so when you think about DeFi, it's important to caveat it with the fact that, again, so much of DeFi today is just sort of crypto assets speaking to crypto consumers and being transacted amongst them, and not linking back to the real world. The other big caveat or limitation that I want to speak to for a moment about DeFi as it exists today is that much of DeFi, almost all of DeFi, I would argue, rests on the notion of over-collateralization. And so when we talk about, as Jonathan rightly points out, when you talk about the fact that so many DeFi applications and protocols have proven themselves resilient in a way that, for example, Celsius and Voyager and these other big lenders have proven to not be solvent or viable, and the success of DeFi in that sense, it's important, again, to note that DeFi came out a winner perhaps here, but really that was in large part because all of the systems that have proven resilient have rested on the idea of over collateralization of the loans that are taken out on those platforms. And I think that we could probably erase the last sort of millennia of financial innovation and economic gain if there was no way for us to access true leverage that didn't rely on over collateralization, but instead rested on trust and identity and these types of things that we have not yet found great proxies for in the DeFi world. So just to be your bear again for a second, Dan, I think that those are a couple of limitations it's important to bear in mind here, even outside of the question of intermediation.
I want to give you a chance to respond, and then I'm going to come to my former regulator over here, and I'll ask you some questions about how DeFi fits or doesn't fit within the regulatory perimeter. But Tim, your thoughts first.
You know, in essence of getting through all the questions and getting the audience, I agree, I think, with both sides of what's been largely said. I think for the financial institutions in the room and on the, on the video conference and that are going to listen to this, viewing DeFi as something they want to embrace and interoperate with. I come from a deep technology background. You heard Phil talk about this. You heard it in the earlier panel this morning as well around optionality, interoperability, open source, open technology. I believe there's a strong position where our current financial institutions can really embrace the concept of DeFi, embrace the underpinning technologies, and be part of the solution. I'll be interested to get a former regulator's point of view on that. And it's not one versus the other. It's not one, it could be one displacing the other if it's not embraced, if we don't look for interoperability. But if we do, then it's an augmentation of the two concepts and really satisfying how consumers want to interact, what they want to do, providing the right controls, consumer protection, et cetera, et cetera. Let's not view it as one replacing the other, but let's view it as a way to continually evolve where we all need to go as consumers using that technology landscape.
Yeah, so let's talk about DeFi from a regulatory perspective. I mean, there's some who argue, hey, this is just technology, therefore there's no regulated activity here, there's no regulated entities. Then again, we've heard Christian and others kind of weigh in, well, wait a minute, I mean, maybe these are new intermediaries. They might just be operating differently than traditional intermediaries. So the easy question to you, Matt, is like, does this in the future, can it operate outside the regulatory perimeter? The answer is no. Then how does the regulatory perimeter accommodate these newer models that don't look like a traditional model?
So a few thoughts. I mean, I think one is that, I mean, it already does exist outside the regulatory perimeter, right? And I think that will just continue to be a reality. It's a global phenomenon, and you'll have aspects of DeFi that are permissioned, some parts that are not permissioned, and I think you'll have sort of multiple financial systems emerge, right, and potentially bridges that that connect them together. But I think it's really hard to think. So another thought is that, and I think this is kind of where regulation, like the posture of regulation really matters, which is that I think our regulatory approach is typically focused on sticks as opposed to carrots. And I think with DeFi, it's a space that really requires us to rethink that and to think about how do you create a set of incentives or carrots for folks to come and innovate within a regulatory perimeter. I think the best analogy I've heard that I can't take credit for, but I really like for DeFi is that it's sort of like the transformation from a solid to a liquid to a gas, right? And if you think about if regulators today are used to like a solid, and DeFi has leapfrogged to being more like a gas, how we regulate that will have to be probably totally different. I mean, the other point that I'd make, and I think Jill made some really good points, is that if you abstract away and reduce kind of the purposes of regulation to the core fundamental purposes that exist, it's not that many things, really. I mean, it's consumer protection, it's safety and soundness, it's market integrity, it's systemic stability. Maybe there are a couple of others, but it's they're really only just like a handful of core objectives I think you're trying to achieve as a regulator at the end of the day. And DeFi may get you 40% of the way there, actually, with the transparency that exists, with the ability to have smart contracts that do automated liquidation. So I think that as we think about, how DeFi interfaces with regulation, I think one important way to think about it is, I think you really have to start at first principles and say, well, how far does DeFi, the unique properties of DeFi, get us compared to the core outcomes we're trying to achieve, and then try to solve for the remaining gap.
Okay, so this topic of digital identity was raised, and maybe for this, I'll go back to Jill to maybe get us started, and I imagine all of you will have thoughts here. But digital identity seems like it's the gating item. It's like the threshold question for how you access DeFi in a future metaverse. All of that is going to be tied to some form of identity. How do we think about that? Can we solve for the needs that law enforcement, that regulation will require when it comes to ID, at the same time as safeguarding people's privacy and not creating kind of the ultimate of honeypots, if you will, in the future where everybody's information's everywhere? So how do we solve that? Another very simple problem. Jill, maybe we'll start with you.
Yeah, absolutely. And I think that this is actually a great segue from what I was saying when I left off, which is that to unlock true leverage, to unlock under collateralized lending, to unlock all kinds of use cases, as you allude to, whether it's across gaming, coordination, social coordination of decentralized autonomous organizations, things like this. To unlock so much of this, we need to start to have notions of on-chain identity. And we're already seeing some of this play out, right? In a very basic sense, you could consider a given person's wallet address their identity in this crypto Web3 virtual world. You've seen people really take to having their own kind of domain names that are associated with their wallets, where I can be jillgunter.eth, and people can go on to these blockchain explorers, they're called, and see what exactly I'm doing with my assets or on chain in real time. And that's all very kind of cool as sort of lightweight applications that don't necessarily have applicability to institutions or to more mainstream use cases. But you're exactly right, Dan, that as we start to think about more institutional actors coming into the space, and as we start to think about more applicability of all of this to finance in its fully fledged regulated form, we're going to need both, number one, more robust systems of identity that's not just sort of a jillgunter.eth domain name that I was able to go on and buy myself. So we're going to need issuers of identity. We're going to need standards for how those issuers issue and attest to identity on chain. And most importantly, I think, and this is very much what I'm focused on with Espresso Systems, we're going to need systems that protect that data, but reveal it or disclose the necessary features of it when needed, whether that's by law enforcement or whether that's by counterparties or whether that's by the members of the DAO that you're trying to join. It doesn't always have to come back to regulation, law enforcement, although that's probably the easiest thing to grasp. And what's really exciting is that there are technologies that have been sort of nascent for many years, but really kind of come into their own over the last few years in the context of Web3 that can enable all of this. And so one of these technologies that my company is specifically focused on, it's a cryptographic system called zero knowledge proofs that effectively allow you to prove something without disclosing the underlying information, hence zero knowledge. So you have zero knowledge of the thing itself. And to give just a very brief example of what this would look like in the real world, if I could use zero knowledge proofs to, say, get into a bar, I would be able to prove to the bouncer at the door that I am indeed over 21 without having to reveal to the bouncer my birth date, my driver's license number, my address, my name, all of these things. And so what's exciting is that we're starting to be able to experiment with ways of having identity on chain and to be able to reveal elements of identity that are pertinent to counterparties or enforcement or whoever without having to disclose kind of the whole thing and your whole social security number and so forth. And so we're actually getting at, I think, even better forms of privacy and data protection, the balance between the two, than were previously viable. So that's kind of the tip of the iceberg, I would say.
Can I just ask you a follow-up? I mean, in that world, there still has to be a source of truth. Is that right? So obviously someone holds that information about my date of birth and knows that I'm really only 22 years old. But who's that source of truth? How does that get plugged in?
Yeah, exactly. So as I mentioned, one of the biggest challenges with this, it's not actually a technology challenge, although my CTO and co-founder might say differently that the tech is also very hard. But a lot of this is just human coordination challenges, right? Of who is the issuer or the attester of this information, because there does have to be that source of truth that everyone kind of coalesces around and says, okay, yes, we trust this. And there are many different models of this, right? So it could be a KYC provider that already exists today, that is already in the business of collecting and validating KYC information, that can then attest certain things that, okay, you know, Jill has passed her KYC test. It could, in a more grander vision, although maybe not so grand if you look at Estonia, who's already been doing this for many years, it could be the government itself issuing digital identity. It could be individual organizations, right? You know, if Espresso Systems were to issue a credential to me on chain, which would be trivial to do today, saying, okay, in fact, yes, Jill is a co-founder and employee and has been since this date and time. That's maybe not such an interesting form of identity as it would be if it was, you know, sort of the full birth of my information. But that is a form of identity, and that's a much lighter lift for them to become an issuer of that identity. And so this is, again, I think that it speaks to the cool thing, the promise of this technology as a whole, is that it opens up a world of sort of competition and participation where anyone can come in and start experimenting this. We don't all have to sort of wait for, you know, a government actor to come in and be that issuer.
All right, let me go to Tim. I know you're doing a lot of work and thinking a lot about digital ID as well.
Yeah, I think so. The first thing I agree with a lot of what Jill said. And standards is probably the basis for where we have to build off of. We have to start to build some standards on how institutions, corporates, governments, individuals are going to either request an issuance or attest to an issuance or build that consensus, that zero knowledge proof that Jill talked about. And so defining standards around how the government also needs an identity, right, at various levels, right? So the government at a local level, at a state level, at a federal level, have to be able to tie into this system. And I'll get to why that's important in a moment. Corporates need to tie into that level, and then nonprofits, as well as obviously all of us as consumers, because everyone needs an identity to participate in this truly decentralized, ubiquitous ecosystem. And so it's not just about what consumers want, it's also what I think some of our corporates and governments want. You know, we talk about a lot of the nefarious things that can happen around this technology, and I agree with Jill, it's not a technology issue, it's a adoption issue. Estonia is issuing those. You look at what's going on in our northern border in Canada with secure key based on Hyperledger with the 6 major banks and the government. You know, they're supporting this notion of digital identity, and then even to the point of real-time taxes. So how many in the government would like to actually start to look at real-time tax? These are things that I started talking about, you know, 6 years ago. All of us as consumers may not want to do that, but if it leads to transparency where the tax dollars go, because I know the identity that took that tax, and then the identity of who uses that tax to what road or bridge or infrastructure project it's going to, identity is key not only for us as consumers, which Jill talked a lot about, but it's about for all of the players in the ecosystem, all the way to the government. And I think that can build a lot of trust with the individuals in the government if we really embrace this, standardize it, and start to work through that zero knowledge proof, and building out a consensus mechanism of who everybody is and what everybody is doing in this ecosystem.
So Jonathan, Christian, Matt, any additional thoughts you have on digital ID?
I mean, I would just say that this is an area that it's been, you know, known that there needs to be a solution here for a long time, not just for Web3, but for kind of digital finance generally. And it's an area where a lot of really talented founders have tried to crack this nut, and it's really hard. So I just agree 100%. It's more of a human challenge in kind of building the network effects associated with it. And then the data repositories for the source underlying data, the vital records, are fragmented. I mean, they're often with state vital records agencies for birth certificates and things of that nature. I think one important role for government would be to create, and I think typically it's just like a few vendors who have access to those records, right? So one thing government could do would be to, create a more standardized system for accessing these records, and with an API or something like that.
I would just add that, that building on Matt's point, a lot of folks have attempted to do this. A lot of firms have not succeeded, even though a lot of venture capital has been put into space. I think it goes to show that it's in some ways a solution it's very much a problem that needs to be solved, but there's not enough utility right now, and in terms of Web3 to generate revenue and value there for to make this a viable business. That's the kind of weird spot we are, where people that have started in this several years ago basically kind of exhausted runway. It's run into really, really tough walls. I will say that I think as we think about edge computing and NFTs, there's ways to think about digital ideas being composable, building on kind of Jill's point, and having this be dynamically applied to a number of diverse applications. And that ability to have standards that can allow these things to be dynamically applied based on the scenario. If you're going through passport control versus going to open a bank account versus going to OpenSea, all of those require different amounts of information. And that's the beauty of I think zero knowledge proofs. You can verify this in a way that protects the privacy of the individual. And I would simply say, if we put the individual first and have them be the aggregation point for this data and for these kind of pieces of information, it's a game changer in how we can have this be frankly economically viable and practical for broader audiences.
In part two, you need the regulatory system to allow that, right? Because right now, every financial institution is going to go ahead and pursue its own KYC of an individual. So the idea that they're going to be able to kind of verify and ping some other source has to also be accepted. So there is, at least in my view, a regulatory component of at least understanding what's possible. Like what's possible from a tech perspective can help inform what policy might end up looking like. Christian, I want to give you a chance if you have comments on digital ID, and if not, Jonathan just raised the topic of NFTs, and I'm going to come to you on that as well. But let me let you first get the final word on digital ID.
Yeah, really briefly, I think identity is an interesting one, mostly because when you think about the gap between the promises of crypto and blockchain and the actual progress to date, it all stops at what economists call the last mile, like that bridge between the offline world and the online one. Identity is, of course, that bridge, but there are other bridges that are really important for making these networks more useful. And they're complex problems, right? So verifying that someone trying to do a payment on a ledger is actually who we think they are, or that the transaction complies with travel rule and AML CFT, it's challenging. And blockchain doesn't fix that per se. That said, I think it provides a new toolkit, and especially when you look at the intersection of privacy and identity, we have a lot more granularity. So before, to some extent, things were either public or private or visible to a commercial entity. Now you can have all sort of conditions, and you can have transactions that are potentially visible to law enforcement under subpoena, but are not visible maybe even to a commercial third party. So again, the toolkit is broader, but I think it's going to take multiple years to learn how to use it and to fill the gaps on things like identity.
Okay, so we've been successful thus far in not really digging in on any assets, and I promised that at the beginning, but now we're going to talk a little bit about a set of assets, I suppose. So NFTs, it was part of our panel title, but it's important because when we're going to talk about, Metaverse, I think we need to talk about NFTs. But Christian, what is an NFT? I mean, and what's the craze around this? Is this an asset? Is it an instrument? Are people investing in these? Like, what's this about?
Yeah, let me zoom out. I mean, from an economics perspective, NFTs are actually quite a breakthrough. Like crypto and things like Bitcoin and Ethereum before them. An NFT is a non-fungible asset, which is kind of an interesting name, right? It's the opposite of fungible, so it's unique. Each one of these tokens is meant to be one of a kind. Now, that may not seem like much, But let me roll back the clock actually to when the music industry was hit by something called file sharing and torrenting and all sort of digital piracy. Some of you may remember at that point, the industry was scrambling to figure out how will they survive? What's the business model in a world where, music that used to be harder to copy, it wasn't impossible, but it was harder to copy, is now, instantaneously replicable at global scale. That's a good property of digital goods, right? So if I have an attachment, I can send it to all of you. You all receive the same attachment, and I don't have to incur any additional cost for sending you the same attachment. That turns out to be a fatal flaw for any market for digital assets. The moment an asset is easy to copy and, I can send the same music piece to many, then defending the digital rights of the creator and monetizing around that becomes a lot harder. So the music industry figured out to kind of cope with that by evolving into streaming. And to some extent, I think consumers are really benefit from a broader set of goods and services in that. But there's a number of other spaces where digital work of any type, from a piece of art to music to a blog post to some commentary, everything we create that is digital has been very hard to monetize, to resell, and to kind of track through kind of a marketplace in the same way we do for physical goods. So NFTs and blockchain technology more generally, so the combination of a non-fungible asset on a distributed and decentralized technology, say, the Ethereum blockchain, that combination really expands what we can do in the digital space. What do I mean by that? Is that now, creators can monetize their work in a more direct way with new channels. That work can be monetized through new business models where, in a sense, the balance of powers, and this is kind of a recurring theme in all of crypto, the balance of powers between the intermediaries, think about music labels, digital platforms, social media platforms, and alike, and the creators and consumers is shifting again. And why they're so interesting is because, of course, once you have a marketplace, there's all sort of things that come with it, including you hinted at speculation. Many of these assets are meant to be kind of consumables or collectibles, but of course, a big part of the frenzy, especially of the last year or so, has been around, okay, what is the future speculative value of investing in this asset? So really a blurring of the lines between more traditional financial instruments or investment assets and other parts of the creative industries. So to summarize, NFTs give us really a way to track ownership and digital property rights in a way that's distributed and novel. That enables new types of marketplaces and business models. And I think, if you zoom out, it's going to take us some time, but all of this is really good news for anyone that makes a living out of creating any sort of digital byproduct. Because now, again, they'll have more options, and the aggregators that have emerged over the last 10 years or so will be more challenged because they'll have to compete with new forms of aggregation and distribution for music, video, text, art, you name it.
Let me just push on this for a second, and Christian, you can answer any of other panelists, but my understanding is that right now, a lot of the NFTs it's digital artwork. And again, my understanding is once there's an NFT of an image, say it's a photo of these flowers, it's true that the first NFT, the first token of that photograph will be unique. But the truth is anybody else can still take that photo and create a new token. Like you can still tokenize that photo. So it doesn't stop copying per se, but what it does do is allow the first person who received that photo to say, but I have the original. So it's almost like saying, you're able to prove that you've got the Mona Lisa, like the real Mona Lisa, but everybody else can still make copies of the Mona Lisa. So am I missing something with this? Like, I guess, is it the provenance? Is it being able to prove I was the first?
If I can add a thought here, like at Snickerdoodle, we were founded on the notion that NFTs would be the cookies of Web3, hence the name Snickerdoodle, which probably makes a lot more sense to the audience now. But like the thesis here, and Matt's heard this story before, is that I'll be the first one to say, and this is going to be controversial, I think 99% of the NFTs in market right now are going to go to zero. Investors are going to get a wash. Consumers are going to get a wash on this. The technology is, to Christian's point, extremely powerful. But I think the speculation is basically brought in a ton of bad actors who have made short-term profits. But if we go to the underlying technology, I mean, this is going to enable, I think, on the enterprise side, a number of diverse applications that, to Christian's point, will fundamentally. So we're talking about things like coupons and receipts and tickets and licenses and credentials that open up new ways of everything from, having certification for coding camps and those types of trades to, frankly, how do you parcel out resources from the federal government to individuals based on what's in their kind of digital wallet. So these will become incredibly powerful, although I think they'll be less valuable as a whole. We're going to see trillions of NFTs minted the next 10 to 15 years, and the enterprise applications will be game changing. But this art and speculation, I think, to look at that is to look at a very myopic, very narrow-minded perspective of the technology class.
And maybe to answer your
From our bulls here. I'm sorry. Go ahead, Christian.
Oh, no, sorry. There's a bit of a delay. So to answer your point, I mean, I think people always struggle with this, right? Because of course you can make a perfect copy of a JPEG. But what's interesting here is that, and this is where I think NFTs are not there yet, is that eventually, going back to last mile frictions, some of these assets will also carry real legal rights in the offline world. And this is, again, a bridge between the digital and the offline, from copyright to right of commercial distribution. And in fact, we're seeing projects that experiment with all of that. Once you have those things attached, these objects become a lot more powerful. But yes, I mean, to some extent, it was also easy to replicate a Mona Lisa if you had, a forger copy, piece by piece, the original, and there's still value in society for kind of being able to pinpoint, I'm the actual owner of the original piece.
It might be worth highlighting some other potential use cases of NFTs. I think one of the other advantages is potentially the ability to remove rents from transactions that take place. So the ticketing space, we're already starting to see this. NFTs as tickets to events. I think anyone here who's used StubHub or other platforms know how expensive it can be to sell a ticket, or and the fees that can be involved. I think that could be, and again, it's already happening, really, really powerful. Another area I think is interesting, kind of adjacent, is in the travel industry, and tokenizing travel reservations, like hotel reservations, and creating secondary markets to provide travelers flexibility in case they need to cancel or sell a reservation. So, and I think that, who knows what's going to drive the next wave of innovation in the space, but I think it very well could be real world applications of NFTs.
Now that's helpful, and I think it's worth pointing out, it's the authenticity of being able to say, I've got the original ticket with the seat number on it, which allows you to use it for that use case, which makes a lot of sense. Yeah.
And just bridging a couple of what Matt just said, which completely agree with, and Jonathan said around the technology being the underpinnings. When we think about, again, back to the consumer and the data that's stored with the transactions that they have to their digital identity, if we get there, or that's stored in their transaction log in their wallet before we even get to a true digital identity, consumers are going to be able to monetize that data. And that's going to use this same technology structure where they can almost reverse auction. So it's no longer building loyalty where I'm getting push notifications, but I'm throwing a party, Mexican theme, it's this many people. I'm going to leverage this technology to auction off to whoever wants to bid on it to supply me with the goods to throw that party. It's the same fundamental technology behind NFTs that allow us to know who I am, what I need, so on and so forth. So there's so many applicable aspects of how the technology can be used that will tie back to the consumer monetizing that, just like the Christian and Jonathan were talking about in a marketplace concept as well, whether it be art or tickets or what have you.
Membership is the other big category that has been significant, whether that's membership in a virtual metaverse community or membership in other types of real world communities.
All right, so let's shift to another topic that was listed in our title here, smart contracts. And I think this is really important. We've talked a little bit about programmability. I tend to think about this as, driving automation, but it's one of the key advantages that's talked about a lot when we discuss these underlying technologies. But let's go a little deeper. Like, what does this mean? Like, so help me define what is a smart contract. And what is this programmability point? Like, what does it mean for the future of money? Why are technologists so excited about this? So Maybe Jonathan, I'll start with you, and we can go around the horn on this one.
I mean, when it comes, I think, down to the kind of the core technology here, this is what enables everything to be very differentiated from, I think, what we've seen in the past. So the programmability layer becomes mission critical to automating, to basically expanding what's possible, and making this frankly easy for large institutions to kind of have a broad spectrum approach. I think the conversation we had earlier on some of the DeFi kind of dovetails into this, where we have to have a human element to make sure that code doesn't override things that are necessary. But broadly speaking, I think this is what makes blockchain practical and differentiated, other than just being decentralized. It's the programmability is the other kind of key issue apart from decentralization.
So Christian, can you help us though, like unpack what does it mean? Give us a very good explanation of what these smart contracts are doing.
So first of all, smart contracts are and I'm not the first one to say this, but they're neither smart nor contracts. So they're not contracts in the legal form of the law. And they're not that smart because to some extent they will execute exactly what's in the code. And in fact, we've seen moments in blockchain history where that has turned out to be a major source of drama, like the DAO hack. At a very high level, they allow you to pre-program certain operations. So state transitions that could be valuable in any one of these systems. The reason why they're not smart is that often they need to be invoked. They're not like running in the background. In many mechanisms, when you think about the stability mechanism for an algorithmic stablecoin like DAI, there needs to be a keeper, either a human being or some other type of bot or code that is running and invokes this contract to perform the right operation at the right time. When we think about the potential, what's interesting about them is automation, and to some extent also modularity. You can start, building, and this is kind of the Lego blocks of DeFi that, depending on how you think about them, are a massive source of systemic risk and additional complexity, or they're really powerful. When you have a contract doing one thing, you can then plug it and have an interface to a contract doing something else. And that's how you kind of rebuild a lot of the functionality from payments to more advanced financial services that we have today in the financial system through code. That's why I think people are excited. That said, there's a lot of risk with smart contracts. Again, if the code is wrong and there's a bug or a vulnerability, that can be exploited, and it's often irreversible. And more generally, as we build more and more complex things, it starts to look a lot like 2008, where we thought we knew what we were dealing with, but the structures below that were a lot more complex and fragile.
So Jill, your perspective on this? I mean, are you guys using smart contracts as part of these zero knowledge proof techniques, or how do you see it fitting in?
Yeah, so smart contracts is one of these tricky terms that has come to mean many different things depending on the context in which you use it. And so to the extent that we are building smart contracts on Ethereum to build out the applications around privacy and scalability and so forth, yes, indeed, we are using smart contracts. I think that very often smart contracts get used as kind of a proxy term, though, as well, for this notion of programmability and composability. But I want to emphasize that they can be used also more generally. So if you hear people talking about building smart contracts, it doesn't necessarily mean that they've built this sort of leaning tower of financial innovation that Christian was just describing. It may just mean that they have built even a basic wallet application that's interacting with a blockchain. But I think that Christian's point here is an important one, and to give maybe a brief example of the composability and what we mean by that. So today, if you want to go and create some sort of convoluted structured product, you basically have to call up a Wall Street trading desk to create that structured product for you, wherein you describe to them what kind of exposure you want and what exactly the cash flows of the asset that you want are meant to be doing. And I think that what is both exciting and also somewhat scary about Web3 and smart contracts, again, meaning kind of composability in this context and programmability, is that suddenly anyone can do that. And so you can take an NFT that represents a ticket to a concert, and part of the cash flows of me paying for that NFT are automatically and programmatically directed to the artist who's performing at that concert. I can then sell that ticket or that NFT on the secondary market and generate cash flow from that. And that secondary sale could also be siphoned off to the artist. Then I can go in somewhere to a lending platform and post that NFT as collateral for a loan that I'm taking out. And if the value of that NFT on the open market drops below a certain threshold, then I'll automatically be liquidated. It's this sort of amazing kind of, again, composable system that anyone can access, which is, again, I think both an incredible innovation and an incredible thing to see the innovation that comes out of such an open system, but also I think the cautionary tales almost write themselves, right? So that's how I would describe a lot of what's going on with smart.
I think your hypothetical has a room full of regulators sweating right now when they heard all that could go wrong there. So I'm going to let Tim and Matt weigh in as well, but maybe I'll kind of shift this to the topic. Let's zoom out and talk about Web3 and the metaverse. How close are we to these states? Are we using smart contracts anywhere close to the way that Jill just described? How far off are we from a real Web3 design and then this potential future metaverse where we spend most of our time?
So I'm sure all five of us would give you quite different answers at some level, and then you survey the room and they would have different perspectives as well. I'll use the word nascent because I do think it is still nascent in the grand scheme of all the interactions and all the things that happen around the web and financial institutions and consumer payments and money movement cross border, all the things we've heard about today. This is still a very small fractional amount. That being said, it is happening. There are people paying with stable coins or Bitcoin or Ethereum for their morning coffee in Miami every day. That's a reality. There are people, I actually got a text today because some of my former colleagues at IBM, actually had a meeting in the metaverse with one of their customers today, and they knew I was here speaking on it. And so they are people that I interacted with 25 years ago, and they met with their customer in the metaverse. So it is a reality, it is happening. It's just then to what extent is it happening and how real are some of these things? And so to build a little bit back off of what Jill was just talking about on smart contracts, and completely agree with Christian, there can be danger because it's programmable, but it's programmable today. When people take a file from a company or from a bank and process that file for a money movement, if somebody had a defect in the code, it can screw up, right? And it can transfer the wrong amount of money. Now, maybe people believe it's more reversible today, but if we have the transparency, we have the logging inside of the systems, we have the ability to go affect that in these systems today as well. So I don't know that it's completely contrarian to think that our current systems have more capabilities or are better serving that purpose today than what these smart contracts might be. And to an earlier point that I made, which is also going to freak out regulators, we all know what sales tax is when we buy something. We all know what VAT tax is when we leave Germany or France with goods that we've purchased. If we have programmable smart contracts and we have digital money, could be CBDC, could be a stable coin, it could be a speculative coin in our wallets, what's to say that we can't have smart contracts that programmatically take that sales tax and remit it, or that VAT tax and remit it immediately, versus trusting the process every quarter, every year, so on and so forth. So I think there's reality happening today. I think there's a lot more reality that could happen if we embrace the technologies moving forward.
I think if you automated the return of the VAT tax to travelers leaving Europe, you'd get a lot of consumer adoption, right? You don't want to wait in that long airport line. No, I agree with you. I think the question is really, is this a reality? For whom is this a reality, right? Because it is a reality for some folks. And I've come to a really difficult realization in the last few years, which is that I'm getting old, and that my views of the world I've discovered are different than the generation that is emerging. And it's been pretty eye-opening. And I think if we're talking about the future of finance, and if finance is a human construct, then we need to talk about humans and like what the next generation of humans is going to care about. And I think that, as I mentioned earlier, kind of in the session, I've been kind of looking at survey data and trying to better understand kind of the generation Z, because I've realized it's very different from my generation. And I think there are several notable features that could totally change how people interface with financial services. And this may be kind of a non-consensus view, like a 30% probability outcome, but I think there's a chance it could happen. And I think those features are, I mean, it's Generation Z is the most diverse generation in American history, and they're looking for products and services that see them for who they are, and it's a very diverse set of people. It's the first generation to ever grow up in an entirely digital era, population born starting in 1996. And they've grown up in an age of misinformation and know how to kind of navigate that world in a way that other generations don't. And then lastly, and this might be sort of controversial, but I think it's a generation that's been systematically failed by most of the major institutions of our time. So if you think about 9/11, Great Recession, climate change, recent rollback of women's reproductive rights, you name it, like it's sort of it's a generation that, for whom, if they were to say, look, we're not going to trust institutions any longer to manage our money, like you could look back 50 years from now and say, I could see how that evolved. I could see how this is the first generation to bring back the practice of self-custody in a meaningful way. I think what's different today, in the past, or even today with physical commodities, there's only so much gold you could keep in your house, or only so much cash you could keep in your house. With self-custody solutions, with encryption, with data recovery, and passphrase sort of recovery solutions, improved UX, we're really getting to a world very quickly where you could imagine people holding a meaningful amount of currency in a self-custody manner.
So that's a great segue. Oh, I'm sorry. Did someone want to jump in? Because if not, did I hear someone, or is that just me at 5 o'clock late in the day? Okay. So that was a great segue, though, back to the assets. So, we've avoided too much conversation about assets, but we're talking about the metaverse. And Tim, you just said, whether it be crypto, stablecoins, or CBDC. Okay, well, what's it going to be? I mean, what are people transacting, and what's the medium of exchange? Is it going to be a world with hundreds of cryptocurrencies? Is it going to be one big stablecoin? Is it going to be a digital dollar or a digital euro? Christian, maybe I'll start with you as our economist. Like, explain to us, what does the future of money look like?
My hope is that we'll see multiple of those instruments deployed and used in a safe and sound way. That's not the state of the industry today, and I think the evidence of the last few months has shown that, especially when it comes to stable coins, we need better standards. I think we know how to design robust and secure stable coins. In my past life, as part of Libra DM, I think we had fleshed out, what is a proper reserve and how do you withstand stress market conditions. I think when stablecoins will reach that quality bar, they'll be useful because people will be able to move value across the globe with less friction on payment networks that are an awful lot more interoperable than what we have today. And that would bring more competition to payments and financial services. I think CBDCs are really important. And eventually, I would imagine every major country will have, as part of their critical infrastructure, a central bank digital currency. Whether it's going all the way to the token to the consumer, or using traditional intermediaries, including banks and new ones, as kind of distributors of that CBDC tokens. I think that's very much an open question on the optimal design. But I think CBDCs have a really important role to play from a public sector perspective. There's a number of segments of the population, even in the US, that are unbanked or underbanked. And that kind of technology can really expand on inclusion and lower the cost of payments and services. When it comes to crypto assets, I think, there's many different ones. They all have different economic designs and different purposes. I think some of them will thrive. Right now, we had like a whole influx of old sort of assets because it was really easy to raise money by just having a token as part of your, venture capital pitch. But hopefully over time, higher quality teams and projects will survive and thrive, and we'll see a lot of the noise go out. I think also from a consumer protection perspective, that will be really important. But again, it's a world where I think we'll see CBDCs, we'll see stablecoins play an important role, and then we'll see a number of crypto assets at scale in different applications.
So let me stay on the screen for a minute. Jonathan, Jill, do you guys have additional thoughts there, what the future of money looks like?
Go ahead, Jill. I'll dive in after.
Yeah, I just want to emphasize Christian's point about sort of this open world of competition where all of these things will coexist. I think that that is one of the trickiest, but also sort of most groundbreaking things to wrap one's mind around when it comes to sort of the implications of, I would say, Bitcoin to begin with specifically, right? And now into the world of, centralized stable coins where you have private sector actors issuing them, decentralized or algorithmic stable coins, where they're effectively backed by other assets and cryptocurrencies, and also CBDCs. I think that it's really exciting to live in a world where all of a sudden we can decouple where we live from the assets that we have access to and that we utilize in a day-to-day manner. And again, that may not be even desirable for places like the United States, where we do have relatively high trust in institutions still. It may have declined over the course of the last couple of generations, and hitting a low point here with Gen Z, as has been highlighted. But when you think about contexts where there is very low trust in institutions, where there's very low trust in local currencies, it's really groundbreaking to be able to have all of these things coexist, and to be able to have access to whether it's a dollar-backed stablecoin or to something like Bitcoin. And that's a big sort of sea change that, again, is happening at kind of a human institutional level, and is not just about the technology, but is important to touch on.
Okay, I want to let our other panelists answer too. So Jonathan, I'll start with you, and then I do want to leave a few minutes for questions from the audience. So Jonathan, go ahead, please.
I'll be brief. I think building off the prior points, the one topic that hasn't really been discussed is this notion of interoperability with money. And money has been very and very controlled. If we think about currency controls, we think about the way central banks operate. For I think the future with what we're looking at with stable coins and CBDC, it has to be interoperable. And this allows for a lot of efficiencies. It allows for the programmability aspect to kind of become more practical. And it allows a spectrum of varying degrees of decentralization. So you have the CBDCs. I like to use the pirate to Navy metaphor. If you have CBDCs as the Navy, and things like maybe Tether and Luna that are a little more like pirates, you probably have a spectrum of stuff that are privateers in the middle. Things like USDC, which I think will be kind of sanctioned in a good way by the US government to kind of stave off concerns with the digital RMB. And so you have this kind of spectrum that allows for varying degrees of confidence, programmability, and trust along this element. So we'll see what happens there. The one last comment I'll make is, in a world where you can have access to a dollar-denominated asset, I think the fear from a lot of other central banks, we had conversations this afternoon with the folks here in Sweden, I mean, their concern is dollarization of money. And that is really, really dangerous. I mean, Christian, that was the concern with your former project at Libra and Diem about dollarization of this, and what that means for smaller currencies, outside of the euro, sterling, and in RMB.
All right, Matt.
I think you'll have many different types of currencies. I think you'll have and different types of stable coins. You have stable coins backed by real estate and other types of assets. And I think, but I think you'll probably have just a handful that are frequently used. And I think that's okay actually to have multiple. I think as long as I think that if you have interoperability and they're already innovators that are solving that, then I think that you can still have a sort of seamless transaction world, even if you have a basket of currencies that are commonly used.
If I can just add one quick point, and then we'll get on to a couple questions. I know we're running out of time. I think the simple answer is yes. And we've used a bunch of different acronyms. They are all digital assets, right? I think that's the common thing that we can define. And so my plur would be, if you're a financial services institution, if you're a fintech provider, so wearing my hat from 4 months ago, I didn't care what acronym they used. I didn't care how it was defined, whether it was a currency, a stable, or a store of value, a security, whatever it was. If consumers want to use it, it's a digital asset. You have to support it. You have to figure out a way through interoperability and standards to support that. And this whole audience and everyone that we interact with needs to understand that digital assets are here to stay. We got to figure out how we collectively enable that for the consumers.
You can't end on a stronger bull statement than that. But let's take a few questions. Michael.
Sure. So looking at the geopolitics of the metaverse, do you foresee the same allies, competitors, even hostile enemies in the metaverse that we'll see currently in the physical world? And how do you see smaller economies in the physical world gain more attention or economic value in the metaverse?
Warfare in the metaverse is what I think I just heard. Anyone want to take that?
I think it comes down to basically the kind of the way we think about culture and the power of ideas. And if anything, that benefits, I think, the United States and folks that have freedom of expression. And this is going to be a battlefield for the ideas and the values of I think, Web3. And having more people have access to that, I think, is a very powerful thing. At the same time, we've seen look at what Al Qaeda and others have done with Twitter and social media. I think if you have an open system, those types of things will potentially be pervasive. So how do you compete with that? How do you have concepts of public diplomacy enter the metaverse? You know, I've had conversations in the last 2 months with the State Department about theoretical mission in the metaverse so that you can have these types of things out there. So this is going to happen. It's just a matter of, I think, how willing we are to put our best foot forward and think about this strategically.
So let me do this. Let me ask Aaron and then Todd, maybe you can both ask your question and then we'll end on those.
Sure. Aaron Klein Brookings, somebody earlier mentioned Celsius as an example of success and failure in crypto. And I just wanted to quote from CNBC. The compliance team was too small. Compliance was a cost center. Basically, we were sucking out money and not bringing any back in. They didn't want to spend on compliance, end quote. Another comment from Celsius about executives, quote, they were pumping up the Cell token and actively trading and increasing the price of the token. They weren't shy about it. They were absolutely trading the token to manipulate the price. It came up in two completely different conversations for two completely different reasons, end quote. In addition, someone else said that on the list of stable coins that were well backed and by highly qualified assets, they included Tether on that list. On what basis do you think that Tether is backed by high quality assets? And two, given that compliance was a cost and that there was at least active manipulation of tokens alleged by senior executives, and what basis is Celsius a success of crypto, especially given its failure?
I think that was I talked about Celsius. Let me just quickly dive in. My comments might have been misconstrued. I'm the one who said Celsius is a failure. I'm the one who's saying that this is a sign that DeFi worked because you had resiliency, with Celsius basically having to pay off that collateral before it could access that. So I'm with you. Celsius was a complete disaster. Goes to show the dangers of some of these types of systems. Then just quickly on Tether, I would agree with you. Tether is not a well-regarded asset. I'm not sure who said that, but this is why you have things like USDC and others that I think are much more stable. And having worked on design of stablecoin projects, I can tell you Tether is the example I would work not to achieve. So I think we're actually aligned there.
I'll touch on Tether quickly since I think I brought that up. But firstly, with Jonathan, I think anyone would be crazy at this point to point to Celsius as an example of success in anything. I think that, as Jonathan mentioned, they were a consumer of DeFi applications that gave them leverage. And again, what was beautiful about the whole thing was that you could see the leverage that they had on chain in real time with these DeFi applications. You couldn't see that with the other liabilities that they had. And certainly, I don't think anyone on stage or in the industry at large is going to defend their practices around compliance. With regards to Tether, I think that I touched on that briefly as an example of a centralized stablecoin, which they are definitionally, right? They have been around for a very long time as really the first real example of a stablecoin that at least purports to be one-to-one backed by US dollar-like assets. That is what their marketing materials say. It took them a very long time to get any form of audit whatsoever. I think that I was amongst the loudest voices in the industry in the time when they had not yet had an audit from a reputable firm saying that this is ridiculous. This asset should not be trading one-to-one with the US dollar. If you looked at this in any kind of Wall Street or financial context outside of crypto, it would not be trading one-to-one. It would at a minimum be trading at discount, taking into account that risk. I do think that, to Tether's credit, they have done a lot over the years to demonstrate good faith, although I think that there's also a lot of unanswered questions, and I don't think anyone is going to refute that. So, you know, there's a risk spectrum of assets even within centralized dollar-backed stablecoins within crypto. I would put USDC amongst the safest and Tether amongst the least safe, but they're all in the same category of asset, just as you could say short-term commercial paper is a category of asset, but you're still going to have a risk spectrum and different yields that those papers would trade at, given that risk spectrum.
I think we've got a quick question.
Okay, so quick 2 points, which are in effect, I'm not a futurist, and so I don't predict the future, but a couple of things that were said I think really need to be called out a bit. One is the idea that individuals are going to manage their data for economic return. There's reams of behavioral economic studies that prove to you that that's just not going to happen, ever. People don't just look at your own activity and clicking the box every time you do anything on the web. That's very clear that the economic model of individuals managing information data value just will not happen. The second is a broader concern about DeFi. There's also nothing that I've heard from any of, in this great discussion, by the way, terrific discussion of all these issues, nothing I've heard that suggests that the benefits of all of DeFi that we've been talking to aren't going to go to the existing holders of capital and exacerbate the problems we've had with the financialization of many aspects of our life, because tokenization is really about the financialization of everything. And who's going to benefit from that? History will tell you it's the holders of capital, not some democratic concept that it's suddenly going to give power to the people in the financial world. So
does someone want to take 30 seconds to say why DeFi won't go that direction? Where are my bulls?
I was going to respond to his first point.
All right, you take that one then.
Just from the standpoint of, again, it's been talked about for a long time. It could be a panacea. I agree there are challenges on humans and individuals monetizing their data stream. To Matt's point, I think the future generation and generations that are yet to come will figure that out, right? There's enough smart people around. There's enough technology around now that wasn't there before. I'm pretty bullish on that. Is everyone going to do it? Absolutely not. Are some percentage of people going to do it and do it well? I think absolutely.
All right. Well, please join me. Thank our panel. This was an excellent conversation. And thank you, Jalapa, for having us.